Hey guys, welcome to the next installment of the Self-Funded Sketchbook. This lesson we're going to learn stop loss insurance and specifically specific stop loss insurance. And so if you're an employer, a CFO, or an HR director, or if you're a benefits consultant, your account manager, doesn't really matter. Ultimately, if you want to understand self-insurance, you have to understand what stop loss insurance is. And so in this video, we're going to go over specific stop loss, okay? Okie doke. Specific stop loss insurance, one of the two types of stop loss insurance that a self-funded employer typically purchases. For this video, we'll only look at specific stop loss, and in the next video, we'll talk about aggregate stop loss, how it differs and how it's similar. So specific stop loss is for the very large claims that often are unpredictable, or as I like to call, low frequency, high severity. They don't happen often, but when they do, they typically have a large price tag associated. So at the beginning of the policy period, when a self-funded employer decides what risk level to take, they're going to choose what's called a specific deductible. So anything under, so all these claims right here, under the specific deductible, the employer is funding from their own dollars. As soon as somebody breaches that specific deductible, or as I like to call it a corporate deductible, as soon as a person goes over that amount, now it is the obligation of the stop loss carrier to reimburse for those claims, assuming they're eligible on the plan. And so let's look at example number 6. This claimant has $75,000 in claims. So there's a $50,000 deductible. So what that means is the employer funds the first $50,000, and then after that, now the stop loss carrier is giving a $25,000 reimbursement. In theory, this could be a $3 million claim. It could be a $200,000 claim. But at the beginning of the year, that employer is going to decide what their threshold of risk is. They will pay premium associated with the risk at that level. And any of these claims that go above that amount are now the stop loss carrier's obligation to reimburse. Okay? So all claims above spec. So what that means is you could have 3, 4, 5, 6, 7, 8, or 0 in any given plan year because these are often very unpredictable for a carrier. Since they're unpredictable, that also means a very large percentage of all the stop loss premium is going specifically to specific stop loss. And so on average, that's usually 85 to 90% or more, depending on the group size, depending on the stop loss deductible. And so because you never know when a hemophiliac is going to join the plan or a premature baby is going to be born and stay in the NICU for 3 or 4 weeks, employers will purchase this type of stop loss insurance to protect them against that catastrophic unforeseen risk. Almost every self-funded employer, until you get into maybe the 5,000 or 10,000 life range, is going to purchase specific stop loss. And then at a certain level, a company is so big and has so much cash on hand that they can absorb almost any size claim. And then they might evaluate at that point dropping stop loss altogether. But 95% plus of self-funded employers likely have some form of specific stop loss. Okay, so that's specific stop loss. In the next video, we're going to go over aggregate stop loss, again, how they work together and how they differ. Thanks for joining, guys.